Welcome to the Deep Dive. Today, we are jumping right into the Q3 2025 earnings for NIQ Global Intelligence.
Yep, the scale leader, really the data backbone for the whole CPG and retail world.
And this was a fascinating one. This earnings report, it was just a study in tension.
It really was. They timed the call strategically right before the U.S. market opened. And what we saw was this incredible operating performance.
Right.
But then a really choppy, almost cautious reaction from the market. So our mission today is to cut through that noise.
Okay.
Is this post-IPO transformation actually working? And maybe more importantly, is all this talk about AI finally creating a new sustainable financial profile for them?
All right, let's unpack that with a quick snapshot of the core numbers, because this was, the definition of a mixed bag.
It really set the stage for that volatility we saw during the day.
So starting with revenue, a really strong beat there. Total revenue hit $1,052.6 million.
Which was about $18 million above what the street was expecting, a solid beat.
And their core growth metric, that organic constant currency, or OCC growth, was robust at 5.8%.
And that OCC number is so important for a global company like this. It strips out all the currency noise.
So you see the real business.
Exactly. You see the underlying health. And 5.8% shows really steady momentum.
But then we get to the bottom line, and this is where the divergence, the thing that always seems to anchor this stock, comes in.
Right.
Adjusted EPS was 3 cents, pretty much in line with what were, low expectations. But the GAAP net loss was the headline shocker, $198.6 million.
Which translates to an EPS loss of negative 70 cents.
Oh.
A huge miss compared to the negative 53 cents the consensus was looking for.
And that is a massive, heavy number. It almost derails the whole story if you don't understand what's behind it.
It does. And for you listening, this is the crucial part. NIQ is a highly acquisitive company. You've got legacy Nielsen assets, the huge GfK integration.
So that GAAP loss isn't from operations?
Mostly, no. It's driven by non-cash charges, amortization of intangible assets, goodwill from those deals. Management is basically telling investors, look at our adjusted EBITDA. Look at the operating health, not the historical baggage on the balance sheet.
That distinction is just critical. And here is where the bullish story got its biggest injection of fuel: cash flow.
Oh, yeah.
The major upside surprise was levered free cash flow. It surged to $224.4 million in Q3.
And just to clarify, levered FCF, that's the cash left after paying for everything, operations, CapEx, and critically, after they service their huge debt.
So this is real cash in the bank.
Real cash. And that number, that $224 million, achieved the bulk of their entire second half target in just one quarter.
That's not just a nice surprise. That is a powerful counter-narrative to all the anxiety around their debt.
Absolutely. And you saw that tension play out in the stock price immediately. It rallied over 7% intraday.
As people digested the FCF number.
Right. But it just couldn't hold on. It closed down over 1.6% on triple the normal volume.
So the fast money took profits.
It seems like it. And it left the long-term investors still trying to balance the amazing operational execution against that fundamental debt burden and the ugly GAAP losses.
A classic show-me market reaction. So let's dig into the engine here, the top line. This was the 6th straight quarter of at least 5% OCC growth.
That consistency is just so rare in the CPG space right now.
Management broke down what they call their revenue algorithm. It's about 2.5% from pricing and another 2.5% from innovation and upsell.
And it proves they have really disciplined commercial teams. Their subscription revenue, which is basically their ARR, grew 6.6%. The momentum is just undeniable.
Okay, but 2.5% from pricing, that sounds high. CPG clients are under so much pressure right now. Is that sustainable?
It's a fair question. But the data they provide is, it's non-discretionary. If you're a big CPG making a $100 million decision on promotions, you aren't going to haggle over a few basis points for the data that informs that decision.
The stickiness backs that up.
It does. Net dollar retention was strong at 105%. So the average customer is spending 5% more this year than last.
And gross retention at 98% is just stellar. They're not losing customers.
Customers aren't just staying, they're expanding.
Yeah.
It kind of immunizes NIQ from some of that broader economic caution.
And what's really fascinating is the regional story behind that growth. EMEA was just a huge outperformer.
It grew a leading 8.8% OCC. And that right there is a direct signal that the GfK integration is finally paying off.
So how is that integration directly driving that outperformance in Europe?
They've successfully rolled out their panel-on-demand model there, and it's just winning huge market share. Management said consumer panels grew over 20% in the region.
Why is it winning?
Because they're combining the measurement, the what happened data from the cash register, with the panel data, the why it happened, consumer insights, all in one place.
So clients get the full picture instantly.
Instantly. Competitors often make you stitch that together manually. So, yeah, the EMEA success proves the strategy is working.
Does that give them a playbook then for the slower Americas segment that only grew about 4%?
Management certainly thinks so. I mean, they were quick to point out the Americas were up against a really tough comp, 9% growth last year.
True.
But the path forward is the same. Scale and synthesis. They just launched their big OmniShopper panel in the US, up to 500,000 consumers, to mirror what worked in Europe.
More granular insights for US clients.
Exactly. Plus, activation revenue, which can be a real swing factor, it returned to growth. And Q4 is seasonally their strongest quarter for that.
Yeah, management kept hammering that point home. Even with caution as the new normal, their service is indispensable.
Right. Whether you're expanding or contracting, you need their data to make those multi-million-dollar calls.
And this brings us to what was probably the biggest theme of the call, AI.
The CEO framed AI as the critical factor, widening the NIQ data moat. And, we've heard this from every CEO lately. We need proof.
So what was the proof?
Well, it started with the data assets themselves. 160 petabytes, 220 million unique items, 90-plus markets. They argue that this kind of proprietary granular data is just impossible for a general-purpose LLM to replicate.
It creates a barrier to entry.
A huge one. I love the anecdote they used. Try asking a general LLM, who sold the most chocolate in the U.S. in October 2025?
You'll get some general market trends, maybe.
Exactly. But NIQ can filter that down to just gas stations by specific promotion and break down competitor pricing in a 5-mile radius.
So when you're making $1 billion decision about a new factory, the generic answer is useless?
It's totally useless. And they tied this advantage directly to new products. They talked about NextIQ, their proprietary AI engine.
Which they claim is 10 to 12 times faster than a generic LLM.
Right. And then there's Ask Arthur, their GenAI copilot, which is already speeding up client insights by 40%. The traction is real. They even cited Unilever.
What was that example?
Unilever cut product development time by 65% using their Basis AI tool.
Yeah.
I mean, that's a massive acceleration in speed to market.
And this is all translating to margins, which is what investors really care about. Adjusted EBITDA margin expanded 300 basis points.
Up to 21.3%. And management was explicit. AI-driven automation in coding, data ingestion, customer support, that was a massive contributor to the beat.
So they're on track for that mid-20s margin target.
They are. The whole financial reset is now visible. The IPO in July cut $100 million in annual interest expense. That was the foundation.
And now the AI efficiencies are delivering the cash flow.
Exactly. That strong Q3 performance let them raise the full-year FCF guidance to break even. That's a $225 million improvement year over year. This is the pivot point everyone was waiting for.
And the new guidance backs that up. They raised the full-year outlook and guided Q4 margins to implied 25%.
Which just sets the stage for 2026 to be another year of, in their words, significant margin expansion.
So you have this clear, bullish story from management. Operational beats, AI paying off, huge cash flow. But the stock is still trading, 35% below its IPO price?
And that's the psychological hurdle the market just can't seem to clear yet.
It's bizarre. They deliver on every front, raise guidance, and the stock finishes down. What is that single biggest hurdle?
It's still the debt. The high multi-billion-dollar debt load combined with those big non-cash GAAP losses.
So investors want more proof.
They want absolute, unequivocal proof of sustainability and rapid debt reduction. The stock is down almost 19% in 3 months, while the market is up 4%. That tells you everything. The street needs more than one good quarter to believe.
But the analysts who cover the stock, they seem to believe. The sell-side price targets are still in the low 20s.
Yeah, they see the current price around $14 as a clear opportunity if the execution continues.
And the catalysts are very clear.
Very measurable. Hit that implied Q4 margin target near 25% and deliver that last 55 to 60 million of free cash flow for the year. If they do that, the narrative just has to shift.
All right, this is the part of the deep dive where we put on our portfolio manager hats.
And We have to stress, as always, this is purely for discussion. We are analysts talking about possibilities based on the data we've covered. This is not financial advice.
Never financial advice. So, given this whole situation, you have a discounted leader, an FCF inflection point, huge AI leverage, but it's still carrying this guilty until proven innocent stigma. What's the outrageous but plausible trade idea here?
Well, the core thesis is that the market is still valuing NIQ on its past, on its history, as a complex, leveraged carve-out with messy GAAP accounting.
But the company is actively changing its identity.
Exactly. Management is executing a pivot. They're promising break-even cash flow, significant margin expansion, all driven by real AI and GFK synergies.
So if they nail Q4, the market narrative has to shift from leveraged carve-out to AI-enabled cash flow machine. So what's the trade?
We're calling this one the leverage play on Q4 execution. It's simple. With analysts looking for $22 to $24, you could buy the stock now, around 14, and set a very tight stop loss just below that recent intraday low. Let's say $13.50.
And the catalyst is the Q4 earnings call in late February.
That's it. If the cash flow comes in as guided or better, and their 2026 guidance is strong on margins, this stock could re-rate right back toward that IPO price of $21. That's a significant upside against a really contained risk.
The outrageous part, of course, is betting that a post-IPO laggard can close a 30+% gap in just 3 months, based solely on management delivering on its promises.
You're betting on flawless execution to finally overcome years of skepticism. It's a high-conviction bet that what we saw in Q3 is now the new standard.
So to sum it all up, what we saw was just strong operational discipline. The revenue algorithm is working, the GFK integration is finally driving margin, and the AI story is real.
It's translating into tangible savings and new products. The fundamentals are there.
And for you, the learner, the key takeaway is that tension. Can this operational excellence and cash flow discipline finally overcome the market's deep-seated aversion to the debt and the JAP losses?
That's the whole game. Management has set a very high bar for themselves with those mid-20s margin promises.
They've proven their data is mission critical. That 98% retention number says it all. So now it's just a race between management's delivery and investor patience.
And if they execute in Q4 like they did in Q3, the market simply won't be able to ignore the cash flow story anymore. Thank you for joining this deep dive. We look forward to exploring your next set of sources soon.